Good afternoon and welcome to the Wealth of Advice Market Update on Friday the 10th of July. So another week passes as we go through this coronavirus pandemic. This week has been a positive week in the sense of more businesses are reopening, more businesses are being told they're allowed to reopen. The Chancellor had a mini budget on Wednesday, which I believe a lot of people found encouraging, some of the initiatives that he was trying to implement to try and make sure that we keep jobs or people in employment in this country, encouraging people to go out in restaurants more and such like. So we believe that was an encouraging mini budget. In previous presentations, we've discussed the VIX Index. The VIX Index, quite simply speaking, is a measure of volatility, and volatility is often just regarded as a measurement of risk over time. And what we showed previously was that the volatility index really went off the scale at the beginning part of the year. The graph that you can see now shows how when the volatility index really spiked, which was around about the 15th of March, that's when markets around the world really collapsed. And the market that's quoted there is the S&P 500, which is one of the big markets across in America. This data comes out very easy from American sort of sources, which is why we use it, but it's the same as the UK market, European markets, Asian markets. The volatility index went through the roof, the markets collapsed. Now what you can also see from that graph is that although the volatility index has come right the way down compared to where it was in February and March, it's still almost double the levels that you would expect to see from its historical average. Markets have increased in value as the index has gone down, but you've got to sort of look at that and believe that the VIX index remains historically high, so therefore investors believe that there may be trouble ahead. And I think following on from last week's update, where we said that we just come off the best quarter for a number of years, the next quarter will be interesting to see how it unfolds with the fact that volatility is still quite at a high level. So following on from the discussion there about risk and volatility, people might be watching this presentation and thinking, is now a time, after markets have come up nicely over the last few months, maybe to put some of your investments or pensions into cash? This graph that we're showing now, this chart, really shows why that would not be such a good idea. As we've said in previous presentations and back at the seminar at the Ramside that we had in February, it's all about time in the markets, not trying to time the markets. If you try and time when you pull money in or pull money out, invariably you don't have a crystal ball and you will get it wrong. So it's all about having your money in the markets. Those clients who are invested in Royal London will see that the fund manager makes asset allocation decisions and changes the portfolio quite regularly. Those clients who are in our what we call our model portfolios, the risk score 2, risk score 3 that we mentioned, you will have all received emails over the last couple of weeks asking us to change, permission from us to change the asset allocation and change one of the funds around. So not going into cash at all, but actually just reining in some of the risks. So Royal London's doing that and the model portfolios are doing the same. And as you can see from the chart that we're presenting there, and if anybody would like this emailed over as a PDF, obviously please just drop us an email and ask. But you can see the key difference of actually being in the market for the long term and the long-term benefits and rewards that can give. So hopefully again that provides some reassurance. We're certainly not recommending anyone goes into cash right now, and for all we know the next quarter could be the next greatest quarter like the last quarter was. However, when we look at world news and UK news now, we need to sort of give a bit of a backdrop to what's actually going on right now. So as mentioned at the top of this presentation, we said that Rishi Sunak unveiled a £30 billion package on Wednesday, effectively to save jobs in his mini budget. I believe that's gone down very well. A lot of business leaders up and down the country have said so. There's also the stamp duty holiday for those people buying houses above a certain level. Hopefully that stimulates the housing market to pick back up. But on that point, it was interesting. I watched Sky News on Tuesday morning ahead of this mini budget on Wednesday, and the lady on Sky News was saying, well, who will this benefit? Nobody's really buying houses anyway. We had a solicitor in our office on Monday talking about another matter altogether, and he just happened to comment that during the month of June, his firm of solicitors based in Durham, one of the decent sized firms in Durham, they've had more new requests from people actually buying and selling houses to act on their behalf than they'd had in the previous 6 months altogether. So it does show that a lot of pent-up demand was there for house sales and house purchases, which is now coming through now that the lockdown's coming to an end. So a lot of the negative stories that you may see on Sky News and the BBC, even in newspapers, is often just someone's opinion. I think when you actually speak with people on the ground who are working in these industries, the actual realities are a little bit different. and that will then eventually be shown through in market returns when the real data is published in due course. The job retention bonus is definitely going down well, and if that can be seen to keep people in work after October, then the market should react positively from that. There has been a fear, and I've heard it said from multiple people, that there's going to be huge unemployment come the winter once the job retention scheme comes to an end. But from what Rishi said in his mini budget on Wednesday, I just don't see how that's likely to happen. So other news from the UK this week, which I think may be a little bit worrying. The World Health Organization is saying that the coronavirus is certainly not under control in many countries. However, the UK, as of today, has stopped quarantine restrictions applying from those people arriving in. We mentioned this last week, from other countries around Europe and the world. Also, they've announced that pools, gyms and some outdoor gigs and such like are going to be able to recommence in a few weeks' time. You've got to wonder, is this being done too soon? But who knows? As I say, the experts who are advising the government are certainly keeping an eye on things. If there's a big outbreak somewhere like we saw in Leicester, then they'll just shut down that area. Certainly markets don't believe that anything negative is on the horizon. Whilst the UK market is down this week, it's not down massively, and there's certainly nothing out there that has yet spooked the markets to collapse like we saw at the end of March. In other news this week from around the world, America still dominates the news stories, unfortunately, and that's because they are not getting this virus under control. Many states are reporting widespread outbreaks. ICU, intensive care unit beds are virtually all taken up in a lot of states. I think the governor of Florida has said that he's not releasing any more up-to-date data because the data just looks so bad. And then you've got Donald Trump and the vice president saying that America is the envy of the world, whereas Dr. Fauci, who was their main advisor, I don't think they're talking to him anymore. He's basically contradicting that and saying that's just not the case. So again, the worry there has to be that if the American markets don't like what their management, their president, their officials are doing, that it could bring markets down. The reassuring aspect of that, though, however, is in the end of February going into March, markets fell quickly because there was so much uncertainty as to how governments would react and how they would try and tackle this virus. Would businesses go bust? Well, you've seen in the UK and in Europe the job retention schemes, the helicopter money that's being given to people. This is happening in America as well. So businesses know that they're going to probably survive through this crisis. They've got government intervention, they've got government support and government help. So I think the negative stories that we're seeing from the US and in other parts of the world as well. The Brazilian president was tested positive for coronavirus recently. Will that bring the house down, so to speak? Well, it might mean that markets aren't positive as much in the next quarter, but I certainly don't believe we're going to see the 25-30% reduction that we saw at the end of March. Never say never, but that's just what my personal feeling is on that. There's been so much final stimulus and money put into the financial system that I just don't believe that that's a likely event in the next few months. We're at that part of the presentation again where we discuss the current value of the notional £100,000 invested in either our risk score 2 or risk score 3 portfolios. As you can see from the graph there, the line over the last 2 or 3 weeks has gone down, back up, and it's down again this week. This week hasn't been a positive week for markets. Although some of the news stories were good, that business was reopening, the government's announcing more relaxations, overall the markets are down a few percent this week. However, that said, the risk score 2 portfolio is now worth £97,208 from that notional £100,000 figure in the middle of February, and that's down 2.8% over that period of time. And the risk score 3 portfolio is worth £97,186, which is down 2.81%. So not much difference between the two portfolios. As said in previous weeks, risk score 3's got the highest stocks and shares element, close to 60%, whereas risk score 2 is around about 40%. So we're kind of content and pleased that the funds, if you like, are moving sideways rather than down, obviously. Next week may be a positive week. We need to see what's going to come out from various outlets over the weekend in respect of how the American markets are going to do going forward with their uptick in infection rates and such like, and also whether the markets actually like the announcement that the Chancellor made on Wednesday. So next week again will be another interesting week to see how that all unfolds. The Royal London portfolios, similar to the risk score 2, risk score 3. We put that graph on again there, just looking at the performance there from the middle of February up till now. They haven't performed as well in some instances, and that's because the risk score 2 and risk score 3 have more stocks and shares in them than some of these more cautious portfolios. But again, overall, we're definitely happy with how the last quarter went, and certainly looking forward to what the next quarter brings, and hopefully it's a positive one all the same. So thanks again for listening. As we say every week, if you've got any questions or anything you'd like to raise with us, please get in touch. We are continuing to go through the list of people who need client reviews. We've contacted around about 30 people this week. Hopefully we can continue to pick that up as the weeks progress. So if you get a call from us to do a review, as I say, we'll try and do that over the telephone. But if you want to have a face-to-face meeting and come into the office, then we can situate you in our downstairs office while we work upstairs and connect through the TV links as previously mentioned. So thanks again and take care. Bye.